Welcome. This is India Market Open. We are taking stock of the futures and options space and how things have fared there. Well, consolidation continues, at least as far as the Nifty is concerned, continuing to trade around the 23,300 mark. Yesterday was a day of trade where we didn't see too much, a 0.25% up move for the benchmark. And, well, when it comes to the open interest, very little change as far as futures are concerned. The Bank Nifty, we actually saw unwinding to the tune of nearly 5%. But remember, yesterday was also the weekly options expiry. Perhaps to a certain extent, this had something to do with it. But we saw a 0.4% advance for the Bank Nifty as well yesterday. Now, today is the Nifty weekly options expiry. And while we had mixed cues coming in as far as your overall change in OI is concerned yesterday, moving into today, we're still keeping an eye on roughly 500 point odds range, while 23,000 put is where we've seen a substantial amount of accumulation, and that potentially could serve as a little bit of a base in today's day of trade. On the higher end, of course, we do have substantial amount of writing around the 23,400 and 23,500 calls, and that would potentially provide you with some amount of resistance on the higher end. Not completely ruling out a very sharp up move, but should we in fact see more strength on the Nifty today, and perhaps if it does sustain about 23,400, 23,500, you never know, we could see a lot of these calls being covered. But let's move on and talk about stocks then. And yesterday, again, it was a mixed day of trade, even though we had more gainers than losers, pardon me. And of course, we did see longs in Sun TV, Ambuja Cement, Crompton, shorts for Pidilite as well as Interglobe Aviation, and among stocks which saw unwinding, about a short covering for Container Corp, Balrampur Chini as well as ABB India. And on the other hand, we saw a little bit of longs unwinding for GMR Airport. So these are some of the cues that we're keeping an eye on. But now that we have the big event out of the way last week, now that the dust has settled, we are looking at a lot of these benchmarks consolidating at the moment. The question really is, what do you do with them now going forward? Well, we have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Thanks so much for joining in. What's your reading now, and what's the way forward when it comes to the benchmarks?
Good morning, and thank you for having me. So the current reading on the benchmarks is that the upside is very limited. At 23,400 or thereabouts where we are, we don't see more than about 350 points on the upside. But if you take the second half of June and the July series, we expect that markets might consolidate and have a small downtick as well. And when I say small downtick, we don't expect anything major. We don't expect 22,500 to get breached on the downside. But yes, a small downtick or profit booking is generally what is on the cards and is expected.
All right. So based on that, what kind of an option structure are you deploying, Rahul?
So exactly keeping this view in mind, we've come up with an option structure where what we're doing is we are buying the 23,300 put, but of July series, because we want some time in hand, even though there's about 15 days in June. That's not enough. So we need some more time in hand. So 23,300 put option of July, it's fairly liquid. We go ahead and buy that. This gives us room for the trade to play out. The premium with today's gap up should be approximately around 320 odd levels. To offset this premium, we are using the 4th July expiries. So the first is 23,300 of end July. And to offset this, we're selling 23,000 of 4th July and 22,000 PE of 4th July once again. So I'll repeat, 2 puts we are selling for 1 put bought. The 2 sold puts are 23,000 4th July expiry and 22,000 4th July expiry. A combination of these will give you a premium of approximately 180 odd rupees. So the outflow is about 320, 330 and the inflow is about 180. But mind you, because it's the 4th July expiry, we can gain back some more premium by selling the rest of the 3 weeks of July expiries to make the trade as close to break even in case markets do not move on the downside in June and July. So a little patient trade, but very high probability. Why? Because in case markets don't move down, you barely lose any money because you keep buying back the bought premium with the sold puts. And in case market remains sideways or goes down, you tend to profit on the downside.
All right, Rahul, so then let's talk about adjustments now. Firstly, if you could tell us the horizon for this specific option structure. Also moving on, if we do need to roll over the 4th July puts onto the subsequent week, under what circumstances would you do that?
So the only time we would roll over the 4th July puts is if Nifty stays above 23,300, which is our anchor strike. And we've come to the end of June, or we've come to the 4th of July. Till then, it's just a patient game. The trade needs to be open till July. It's not a trade for the month of June. So how the adjustment would work is we would buy back the 4th July sold puts, which would essentially expire worthless because markets did not move down. The trade went against our view. And we would sell 11th July expiry. On 11th July, we would buy back the 11th July puts and sell 18th July puts, and so on and so forth. Every time we do this, we get back some amount of credit. What that essentially means is our risk keeps coming down with every passing week. So even though the holding period is slightly longer, the risk is very negligible owing to majority of the premium being made back by us by the sold puts.
And if you could tell us about the consideration in terms of risk and reward per lot here?
The risk is fairly low. What we've done is we've kept a stop loss at 22,200. We don't expect the markets to go to 22,200. If you remember, I mentioned 22,500 is where we expect the markets to correct to if there is a correction. At 22,200, you can take a stop loss and exit the entire position. Depending upon the time of the month, we expect the risks to be about 100 to 150 points in Nifty, which would be about 1,500 rupees a lot approximately for I beg your pardon, between 1,500 and 2,500 rupees a lot, which is about 70 to 100 points. And in terms of reward, once again, depends on the time of month you are. If you're very close to 4th July, your reward can be as high as 4,000 to 5,000 rupees, but an average reward to expect should be around rupees 3,000, which is double of our risk, which is acceptable.
All right. All right. So that's as far as benchmarks is concerned. Rahul, any stocks on your radar at the moment?
Yeah. Also wanted to inform viewers that the strategy last week, which was on the bullish side, once again paid off really well once again. On the stocks front, Dixon Technologies is something that we continue to keep our eye on the equity side and on the options side. So Dixon Technologies, what one can do is above 10,400 in spot. It's currently around 10,330 if my memory serves me right. We can buy the 10,500 call of June end expiry and sell the 10,600 call of June end expiry. This would be a simple bull call spread with 10,500 and 10,600, with the caveat that we enter this once prices cross 10,400 on the upside.
Absolutely. Straightforward strategy there. And Dixon Technologies on the radar of several traders who actually deal in momentum, cross-section momentum specifically. And of course, Dixon Technologies is now starting to pop up in some of those scanners. So we'll continue to keep an eye on that one. But Rahul, on that note, taking a moment to thank you for joining us and taking us through your views on the markets, helping us how to employ and use options in such circumstances, and also giving us that call on Dixon Technologies. With that, it's back to you, Taman.